Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to be analyzing Smucker JM Company, ticker SJM. And specifically, we're going to be talking about how I avoided the recent decline that the stock has had. As always, this is not individual investing advice, just how I analyze stocks. All right, so Smucker, as we can see on the fast graph here, fell 15% yesterday. I think it's up a couple percent today on a little bit of a bounce back. But it caught my attention, and I remembered that the stock was looking pretty interesting back on this dip here in 2023 or so. I can zoom in on that. Yeah, so like November 2023, I remember I took a look at it because on this initial dip, it looked pretty interesting based on just the valuation, but I decided not to buy it. So I wanted to make a video where I explained kind of how I avoided the decline from here downward, which is like 15% when the market's up during that time. And then also it's down at least 35% off the high, close to 40%. So with the dividends, it's down about 35% off the high. And I thought it would be useful for me to make a video to explain how I have decided not to buy it and then therefore avoided these declines, which probably people that bought even back pre-pandemic are only going to be, yeah, so they're basically flat, and we've had like 25% inflation or something since then. So in real terms, down 25% over the past 7 years. And I wanted to talk about how to kind of avoid, how you can avoid that and how I avoided it. So let's zoom out and start with the big picture here. So when we go back to let's call it pre-2018, they had pretty decent earnings growth these years. There's kind of an outlier. Now 2018 was a tax cut year, and that's probably why they have this 29% growth rate. That their fiscal year falls in between, and it looks like that one was actually 2017, so there might have been a different reason. But even if we go back here, we have like 8% earnings growth even during through the Great Recession. That's pretty good for like a consumer staples company. These guys make like food, coffee, stuff like that. So that was okay, but the issue is once we get past that period and go here, the earnings growth has been much slower. So 3%, 4%, 6%, 4%, negative 3%, nothing, and then 11%, right? So that was going into that period where it got a little bit interesting for a moment. So now usually when I do an analysis, so I'm just doing, my standard analysis, I'll close this to like the current year. Okay, so I look forward to the current year on the fast graph. And then I go back like 10 years, and that's usually to 20. Let's see, if we do 20, we only need to go back to 2017 in this case because their years are weird. So it'll be like that. So what I initially would notice here is that this 2017 growth year was 29%. That was a big, huge outlier, and it was also the farthest away from the current time. So when I see something like that, I might go investigate and see what happened, but usually I can tell that they're not likely to grow 29% in any of the coming years. It would be surprising if they did. So I just adjust the fast graph, even though my standard is to usually use 10 years. I adjust the fast graph to make it more conservative and probably more accurate. So one of the nice things about fast graph is you can kind of set your own time frames that you want to use. You're not set on the 3, 5, 10 years or whatever a lot of standard kind of metrics that they just give everybody are. And I do have an affiliate link to fast graphs in the description if you want to try it for 25% off, I think is the deal down there. It's either 20% off or 25% off. So when we do that, it gives you a much more conservative valuation, right? If we just look at the basic earnings growth on fast graphs, it was 1.95%. Now they just recently lowered their earnings and that's why the stock fell. But I'm going to look at my spreadsheet, and we can see what the earnings were before that. Did I change it? No, so I haven't changed it yet. I wanted to show everybody what it looked like before this recent earnings report. So my note here is earnings growth is too slow. That's the main reason. I don't have a buy price attached to this. So the way I do things is a business must meet, and the stock must meet certain minimum standards in order for me to have a buy price like attached to it. Now it might meet all those standards and have a buy price and not be at the price that I want to buy it yet. So there's lots of high quality, but if you take, I don't know, Costco or something like that, it's far away from my buy price, but it has one attached to it because it's a good business. I just want to pay a good price for it. And so in those cases, I'm just waiting on the price. But there are some cases where a business doesn't meet my minimum standards, and in which case, really there's nothing that can happen price-wise with the stock that would make me buy it, no matter how cheap it got. So this goes against kind of a basic value investor mindset approach, I think. And it is a point where a lot of people go wrong, because when you're paying, the problem is this. If we look at the earnings growth that I had for them before this latest earnings report, or at least back in March when I last looked at it, the very end of March. So it wasn't that long ago. Based on the time frame that I just showed you in the fast graph, 3.48% was their earnings growth rate. Now, that's positive earnings growth. It's not when you include inflation, but it is positive, but it's too slow. And the danger is kind of what started to happen with them right now. When you go from positive earnings growth, where the market can kind of extrapolate that out and assume that at some point the stock will grow into its valuation because earnings are at least growing. When earnings growth goes negative, then the market extrapolates that out downward. So you get these big, huge moves. Now, this earnings growth rate is only 1.5% or so different than where it is after the earnings report. I think right now I guess it's a little bit more than that. I have a 1.17% earnings growth rate right now after that earnings report. So, yeah, like 1.7, something like that. It's only that much lower now than it was then. But the problem is it's getting close to negative, and the current earnings this year, earnings growth, are going negative. So the market will extrapolate that down. And that's where you get these big losses. It's when if you go from 5% earnings growth to like minus 1%, there can be huge, that could be a 40 or 50% decline in the stock price. And just because of the way, especially if the stock had been growing pretty well before that or was overvalued. And that's why you get this 40%, 35% decline that these guys have had on a relatively, like if you look at it, let me find so if we use the forecasted earnings this year, earnings growth fell 9%, the stock price fell 35%. That's what I'm talking about, okay? It's because of the change in direction as much as it is the actual earnings. So you want to avoid situations like that. And the only way to avoid them, unless you're extremely good at like valuation and forecasting and you're an expert in the industry and all that kind of stuff, and you can kind of see it coming before everybody, which I cover like 700 stocks, so I don't really have that expertise in any particular area. Then you want to be cautious. So when the signs are that earnings growth is slowing below a certain level, or that revenue growth is going below. Revenue growth is even almost more important and more predictive and more cautionary. So when I looked to buy it potentially back in 2023, I looked at the revenue growth, and this is what it looked like back then, the 3-year revenue growth. So this is 3 years. It went from November 2021, or maybe 2020. Yeah, November 2020 to mid-November 2023, which was when the stock price dropped the last time and when it looked kind of interesting because earnings hadn't fallen yet, right? If we look back at the fast graph, at this point, earnings still rose for the next full year. At this point when I was looking at it, it looked interesting. The valuation looked pretty okay. But what kept me away from it initially was this 3-year revenue growth was essentially flat. In a, I don't know, 2023 was like a 9% inflation environment or something, or 4%. I mean, it was way more than this. So over this 3-year period, inflation had over that 3-year period, inflation had risen double digits and they hadn't grown revenues. And importantly, the most recent revenue trend at that point was down for the past couple quarters. So was it completely negative? Actually, not. But this is where you have to like start using your human judgment. I mean, I use a lot of quant numbers to kind of get things in the ballpark, and then you have to look at them and you have to say, okay, that if it does go negative, revenue actually did kind of recover and fluctuate on the upside a little bit. I mean, it was never strong, but right now it's like 8% for the 3-year revenue number. That's cumulative, not like compounded. But it showed signs that the weakness was there. The revenue should have been going up, maybe with a little bit of delay with inflation, but it wasn't even really close to inflation. So we could see that they didn't have the pricing power that a quality business needs at that time. And then the next year, year and a half, now we're getting the earnings are following kind of what we already knew or had some evidence of with the revenue growth. So this valuation actually looks pretty like 8% 10-year CAGR, which is what I'm pointing at here, based on the earnings and earnings growth. Like is at 7.5. Like that's pretty cheap, especially relative to the market. Now I haven't made the adjustments. I'm going to do that here so you can kind of see the difference of what happens with the valuation adjustment. So, but at 8%, that would be a buy. So as the stock price goes down, this number goes up. This is the 10-year earnings CAGR expectation. But when it gets below a minimum standard, then it doesn't matter how good that looks. I don't buy it. And a lot of people think of me as a value investor, but I have minimum growth standards for stocks, because for me, the biggest benefit of owning stocks is that their quality businesses can pass inflation on to their customers. So even in a business like this, it's a staples business. If they had shown that they could do that, then I might have bought them. I buy some businesses that are relatively slow growers, but they can't be this slow. Usually 5% on the long-term earnings growth rate is my minimum right now. And even then, sometimes I'm careful about what I choose to buy. But I mean, I bought Dollar General, right? That was kind of a more value-y type purchase. So it's not that I totally avoid them, but the kind of deep classical price to book type value, they really don't exist in this market anymore. Unless you're a super concentrated investor who really knows exactly, can find things that the market can't find. And I know I'm not one of those. So you're almost always going to fall for value traps if you're an individual investor, and you're not getting earnings growth. So the new earnings growth rate is 1.7%. Okay, that lowered the 10-year CAGR to like 6.87%. But the forward earnings were $10.03. Now they're $9.18. All right. So that lowers it even more to 6.42%. Now the market is discounting this even more than this valuation because earnings aren't growing 1% this year. They're falling 9%. So that's why it's cheaper. Now, sometimes you can get in situations where the market overdoes it, which I think is what happened to Dollar General. They looked at the short term, extrapolated it out. Same thing they're doing here with Smucker. But if you can look at it and say, oh, I think this year is temporary, like there's some reason that's clear to you that this isn't normal and the earnings will bounce back, that might be a situation where you want to buy. I don't really see that with this business. It's not obvious to me anyway that this is like a bounce back situation. And the longer term slow revenue and slow growth, I mean, this isn't like a new thing. This is basically what they've been doing for the past 9 years, 8 or 9 years. So this is a slow decline, slow loss of pricing power, and it'll probably continue. So that's how I avoided not buying it here. And then I avoided not buying it up here just based on basic valuation. It just wasn't attractive. There wasn't a margin of safety. So let's say I had bought it down here. At least I was getting a margin of safety. So instead of being down 35 or 30%, I'm only down like 6%. I don't know if that's 6 per year or 13% total maybe. So you have a much smaller loss, and then maybe you look and you say, oh, I thought these earnings were going to rise, but they fell, like I got surprised. Then you can sell and take your loss, small loss, and go on and try to find, those mistakes definitely happen. I mean, I still make them. I think I've gotten better at avoiding them like this one, but at least if you buy with a margin of safety down here, you're not buying up here and you're down like 25, 30%, probably not a lot of hope of a big bounce back. Okay, so let's see. So I first avoided because of valuation. I next avoided because of earnings growth. And now I first avoided because of revenue growth. And now earnings growth is negative and below my 5% threshold. It's down at like 1%. That's too low. There's no sense in taking on that kind of risk when you can own treasuries or something. Okay, so now I want to point out, because I actually found this when I searched. I wanted to see if this was a dividend aristocrat, because I figured a lot of people, the yield is 4.5% now. A lot of people probably, what do I want here? I think I want, yeah. So you can see the dividends kind of slowly have been rising, and it was. So I hit the search query, and I think it was either Siri or Google or whatever. They pulled up an article as part of they were like, yes. And then they pulled up this article over on suredividend.com. I'll post a link to this in the description. But so I wasn't planning on reading it. I was just planning on pointing out that dividend streaks don't really mean anything. They can get you into value traps. And because the dividends come out of the earnings. So if the earnings growth is slow, the dividends the stock price will either lose money, and these guys are still paying their dividend, but if you're down 30%, who cares if you're getting like a 4% dividend? The value of your investment has fallen, has lost money. So I read through some of it, and because I wanted to see what they, after I clicked on it, I wanted to see what they said. And so this is from like March, the end of March, so it's not that long ago, just a couple months ago. And so the final kind of thing here is they thought that it was a buy right now because of the expected total returns of about 11.2% over the coming years. Those are annual returns, which you saw mine were considerably lower than that. Even when I had the 3% growth, it was like 7.5%, I think, before this late. So around the same time this article would have been posted. So there's a pretty big difference, especially when you compound those rates. There's a big difference between 7% and 11%. And the main thing is because I just happened to look up and saw how they came about this. And so here's their total return calculation. They have 4% coming from earnings growth. That was pretty close to mine. Mine was like 3 point something, so a little in between 3 and 4. That's fair enough. I think that's a fair estimate. Was a fair estimate in March. Multiple expansion. Well, the only way you're going to get multiple expansion, like real multiple expansion, is if that earnings growth rate grew and then the market started pricing in a higher earnings growth rate. There's not really any evidence even back then that earnings growth rate was going to be better. So I don't use multiple expansion anymore. I used to use it in some of my analysis, but once interest rates went up higher, the bias became to the downside, where it's really hard to expand your multiple compared to the past when interest rates are higher. We had a 40-year period where interest rates were generally falling, and so multiples have expanded a lot since then, like a lot. But they're already high. They're probably not going higher. So it's just not usually a good idea to assume multiple expansion. But the real issue here is that they add the dividend yield to the earnings growth. So this is a very common practice, especially among dividend investors and dividend analysis. It's trying to think of a nice way. It's a poor way to do this. The dividends, the basic idea, the basic thing you need to understand is the dividends come out of the earnings, okay? So you can't count both your earnings and your dividends and add them together, right? That's basically a form of double counting. So this is should be completely eliminated. The dividend yield should be completely eliminated. That comes out of the earnings. You just need to look at earnings. The multiple expansion is pretty questionable unless there's like a real driver here. And the earnings growth rate is fine, but you need to place that into the context of the valuation that you're paying for the stock. And then the more nuanced lesson or whatever that I'm trying to teach is 4% earnings growth is too small to buy, no matter what in this environment. So these two things, the multiple expansion and dividend yield, shouldn't be even considered in the current environment. Dividend yield never, pretty much never. There are a couple times when you could pay attention to the dividend yield because, if you have a tobacco company or something like that maybe has solid earnings, but they're not really growing, but the dividend yield is like 8 or 9% and you can earn your money back relatively quickly. The dividend yield can be a kind of insurance policy against kind of slow declines or no growth. But other than that, it doesn't matter for valuation purposes. And then the earnings growth, again, it's just too low, period. It's just too low. There's no reason to buy a stock that cannot grow its earnings faster than inflation 90% of the time, unless you're like a true value specialist. So there's more than one lesson wrapped in this, but the main one I think is look at that minimum. You can decide what your own minimum earnings growth rate is. And mine right now is 5%. It's changed a little bit. It's risen over the past couple years because we have more inflation. So when I look at historical earnings and a company hasn't grown, and we had 20% inflation the past 4 years, and they've only grown earnings 15%, that's negative earnings, real earnings growth. They are showing that they cannot pass those costs on to their customers. And that's going to keep you out of a lot of trouble when you're out there trying to value invest. You really want to have, the value is in short-term treasuries or whatever. You can get 4% at least until now, I think. So you can get that, and that's, 2% above inflation currently. So, and there's not any price risk. You don't risk losing 40%, right? So keep that in mind, think about it, and maybe apply it in the future. I do have weekly picks over on Patreon for $25 a month, and I have a new full service over on Patreon as well, and I have a free tier over on Patreon. So get over there, check out those tiers, join the free tier if you're curious, and I'll see everybody later.